Wars break out. The Middle East is in flames. But why is gold's price crashing? For decades, you've been taught one golden rule. When the world burns, gold is your safe haven. It's the ultimate shield. But right now, in the middle of this massive storm, that shield isn't protecting you. In fact, it's being dragged away to be sacrificed. Forget every technical indicator you've ever learned. Forget the RSI, the moving averages, and the Fibonacci levels for a moment. The real reason gold isn't skyrocketing right now doesn't appear on any retail chart. It's driven by a brutal, invisible summons from the deep corners of the financial world, a summons known as the margin call. Recently, even veterans like Gary Wagner admitted the market is behaving abnormally. We saw gold drop 8% right when it should have soared. Everyone is asking, is the logic broken? The logic isn't broken. The game has just changed. In this video, we are going behind the headlines to decode the secret liquidity war. We're going to explain why, in a global crisis, gold stops being a safe haven and suddenly becomes the world's most desperate ATM. If you've been holding gold and feeling confused or even betrayed by the price action lately, you need to see what's happening in the shadows of the big hedge funds. Because once you understand the sacrifice rule, you'll never look at a market crash the same way again. Let's dive into the anomaly. To understand why the gold market is acting so broken today, we first have to look at the history books. For decades, the script was simple: geopolitical tension equals gold rally. Think back to the 1970s oil crisis, or more recently, the onset of the Russia-Ukraine conflict. In those moments, investors didn't think twice. They dumped risky stocks and piled into gold. Why? Because gold is the only financial asset that isn't someone else's liability. It's the ultimate insurance policy. As Gary Wagner pointed out in our opening analysis, traditional economic rules dictate that when war drums beat, especially in the Middle East, gold should hit new all-time highs within hours. It's an instinctive Pavlovian response from the market. But look at the charts right now. Look at the price action following the recent escalations between Iran and the US. Instead of a vertical moonshot, we see nothing, or worse, we see gold struggling to hold on to basic support levels. It's an eerie, deafening silence. It's like a fire alarm going off in a crowded building, but instead of running for the exit, everyone is just standing there, frozen. This brings us to a massive cognitive dissonance. If the world is objectively more dangerous today than it was 6 months ago, why is the price of safety actually getting cheaper? Has gold lost its shine? Is the safe haven narrative dead? Not exactly. To solve this mystery, you have to stop looking at gold as an investment and start looking at it through the lens of one specific word: liquidity. Imagine your house is on fire. You have a bucket of water in your hand and a bar of gold in your pocket. In that split second, the water is the only thing that matters because it has the immediate utility to put out the flames. In the high-stakes world of institutional finance, Wall Street is currently facing a massive metaphorical house fire. And here is the brutal truth about gold. It is the most liquid asset on a balance sheet. When you look at a professional portfolio, a mix of stocks, long-term bonds, real estate, and gold, most of those assets are currently trapped. You can't sell a skyscraper in 24 hours. You don't want to sell your stocks when they are down 20% and realize a massive loss. And bonds? They've been getting decimated by rising interest rates. So, when a hedge fund gets a call from their bank demanding cash immediately, a situation we call a margin call, they don't sell what they want to sell. They sell what they can sell. They sell the one thing that still has a bid, the one thing that is easy to move, the one thing that is actually still in the green, or at least holding its value. That thing is gold. This is the safe haven paradox.
In a normal crisis, everyone buys gold to hide. But in a systemic liquidity crisis, the kind where the very plumbing of the financial system starts to leak, gold stops being a shield and starts being a source of fuel. It is being sold not because people have lost faith in it, but because it is the only thing left that is worth enough to save the rest of their burning portfolio. Think about the irony here. Gold is being punished precisely because it did its job so well. It held its value while everything else crumbled, and now it's being taxed by the market to pay for everyone else's mistakes. But this raises an even deeper question. If gold is being sold to cover losses elsewhere, who exactly is doing the selling? And more importantly, why is it gold specifically that is being targeted instead of, say, cash or high-yield bonds? The answer lies in a cold, calculated rule of Wall Street that most retail investors never see coming. A rule that turns your best performing asset into your first line of sacrifice. But why gold? Why wouldn't these big institutions just dump their failing tech stocks instead? The answer is found in a ruthless mechanism that operates in the shadows of the trading floor, a mechanism that is about to turn the safe haven theory completely on its head. It's called the margin call, and in the world of high finance, it is the equivalent of a death warrant. To understand the sacrifice of gold, you first have to understand how the big whales, the hedge funds and institutional desks, actually play the game. They don't just buy stocks with their own cash, they use leverage. They borrow money to amplify their bets. And when you borrow money to invest, you have to provide collateral. Now, imagine a massive global fund. Their portfolio is a mix. They have risk assets, volatile tech stocks, crypto, emerging market bonds, and they have safe assets like physical gold and treasuries. Suddenly, a geopolitical shock hits. The stock market flashes red. Blood is in the streets. Those leveraged tech positions start losing value rapidly. Within seconds, the fund's prime broker, the bank that lent them the money, sends a notification. This is the margin call. The bank says, your collateral is no longer enough to cover your debt. You have two choices. Give us more cash right now, or we start liquidating your positions at market price. This is where the panic starts. The fund manager looks at their screen. They need $500 million by the end of the trading day. Where do they get it? They look at their tech stocks. They're down 15%. If they sell now, they lock in a massive loss and potentially trigger a further collapse in the stock price, making their situation even worse. They look at their bonds, but the bond market is frozen. Nobody is buying. Then they look at gold. Gold is the teacher's pet of the portfolio because while the stocks were crashing, gold was likely holding its own or even trading at a slight profit. It is highly liquid. There is always a buyer for gold. Always. So the manager makes the most painful yet logical decision in finance. They don't sell what they hate, they sell what they love. They sell their gold to pay the ransom for their failing stock positions. In this moment, gold ceases to be an investment. It becomes an ATM. Think about the psychological twist here. The retail investor sees the news of war and thinks, I should buy gold. But the institutional whale sees the news of war, sees their stock portfolio bleeding, and thinks, I have to sell my gold to survive until tomorrow. This is why during the initial phase of a major market crash, gold often moves down in tandem with stocks. It's not because the fundamental value of gold has changed, it's because the financial system is cannibalizing its safest asset to keep the leveraged machine from exploding. They don't hate gold. In fact, they probably want to hold more of it than ever, but they are desperate. They need blood to keep the heart of their financial body beating, and gold is the only O-negative blood type in the entire market. It's compatible with every liquidation need. This is the sacrifice rule. The strongest asset is the first one to be slaughtered in a liquidity crisis because it's the only one that can actually raise the necessary cash in time. It's a brutal cycle. The more the stock market falls, the more margin calls are triggered. The more margin calls are triggered, the more gold is dumped onto the market. The price drops, and the retail investor, watching the ticker, starts to panic. They think, wait, if gold is dropping during a war, then the world really is ending. I should sell too. And just like that, the whales have inadvertently triggered a mass exodus of the very people who were supposed to be the safe haven buyers. But here's the real kicker, the twist that most people miss. While the Western hedge funds are frantically tapping the gold ATM to cover their losses in Silicon Valley or Wall Street, someone else is standing on the other side of the counter. Someone is watching this late hand sete, this sacrifice, with a very different set of goals. Because while the West is selling gold out of necessity, another group is buying it out of strategy. And as we move into the next part of this puzzle, you'll see that the ATM isn't just spitting out cash for the West, it's transferring the very foundation of global power to the East. If you thought the margin calls were intense, wait until you see who's catching the gold that Wall Street is throwing away.
Because while Western hedge funds are frantically tapping the gold ATM to survive, another side of the world is treating this as the buying opportunity of the century. This is where the story shifts from a simple market correction to a global power transition. We are witnessing a massive tug of war between the West and the East. In the West, gold is being treated as a speculative tool and a liquidity source. When real yields, that is, the interest you get from treasuries after subtracting inflation, start to climb, the Western math is cold. Why hold gold that pays 0 interest when I can get 5% from the US government? This sentiment, combined with the desperate need for cash to cover failing stock bets, creates a massive wave of paper gold selling on exchanges like the COMEX. But look at the East. Specifically, look at the central banks of China, India, Turkey, and the BRICS nations. They aren't looking at the 10-year treasury yield or the next quarter's earnings, they are looking at the next 100 years. While the West sells paper gold to pay off debts, the East is vacuuming up physical gold to build a floor. This is why gold hasn't crashed to $1,000 or $1,500 despite the highest interest rates in decades. There is a shadow floor being built. Every time a Western fund dumps gold to answer a margin call, a central bank in the East is there to catch it, move it into a vault, and crucially, take it off the market forever. Think about the implications of this. We have two completely different forces acting on the same asset. One force is pushing price down out of desperation. The other force is holding the price up out of strategy. But there's a third player in this game that is making the ATM work even harder, the US dollar. When the Fed keeps rates higher for longer, the dollar becomes a wrecking ball. It crushes emerging market currencies and makes it even more expensive for international investors to hold gold. This creates a pressure cooker effect. The price is being suppressed by high rates and dollar strength even as the world becomes objectively more dangerous. It's like a spring being compressed by two giant hands. On one side, you have the hand of market reality, the margin calls, the high rates, and the dollar strength pushing the spring down. On the other side, you have geopolitical reality, the wars, the debt bubbles, and the massive central bank buying pushing the spring up. Right now, the price is moving sideways because these two hands are equally strong. That's the quagmire Gary Wagner mentioned. That's the sideways candlestick pattern that has everyone bored or confused. But here is the million-dollar question. What happens when one of those hands lets go? Imagine the moment the Fed is finally forced to pivot and cut rates. Suddenly, the pressure from the dollar hand disappears. Or imagine the moment the margin calls finally end and the hedge funds stop selling. When that market reality hand lets go, the spring doesn't just expand, it explodes. We are currently in the quiet before the breakout. History shows us that these periods of high-volume, range-bound trading are almost always the precursor to a massive, sustained move. The gold is migrating. It is moving from weak hands, the leveraged funds, to strong hands, the central banks. It is moving from paper contracts to physical bars. When the ATM finally runs out of cash, the people who sold their gold to save their stocks will realize they have neither. They'll have stocks that are still stagnant and gold that they can no longer afford to buy back. This isn't just a trade that stopped making sense, it's a trade that is being reset for a new era. But as we wrap up this analysis, we have to bring it back to you, the individual investor. In a world of whales, margin calls, and global power shifts, how do you keep your head above water? Do you follow the charts or do you follow the gold? Let's bring this all together to see how you should position yourself before the spring finally snaps. So what is the final verdict on the gold trade that stopped making sense? It makes perfect sense once you realize that gold is currently the only adult in the room. It's being used as an ATM by the West to survive a liquidity crunch, and it's being hoarded as a foundation by the East to prepare for a new financial era. Don't let the sideways charts and the boring price action fool you. The safe haven narrative isn't dead, it's just being overshadowed by the desperate need for cash. Gold is doing exactly what it was designed to do, providing value when nothing else can. The biggest mistake you can make right now is letting your emotions drive your trades. When you see gold drop during a geopolitical crisis, remember the sacrifice rule. Remember the margin calls. The price isn't falling because gold is failing. It's falling because it's the only asset strong enough to be sold. We are living through a massive period of wealth migration. The spring is coiled, the hands are pushing, and eventually something has to give. But I want to hear from you. Are you holding your position to weather the storm, or are you starting to feel the pressure of this sideways market? And after seeing the data, do you agree with Gary Wagner's take on the 78% Fibonacci correction, or do you think the breakout is much closer than the charts suggest? Drop your thoughts in the comments below. Let's get a real debate going. If you found this deep dive helpful, hit that subscribe button to stay ahead of the next market reset. Stay sharp, stay liquid, and I'll see you in the next one.